If you're over 60, there's something happening to your retirement money that most people never notice until it's already costing them thousands of dollars. The surprising part? It's not because they made bad financial decisions. It's because a handful of retirement tax rules quietly begin affecting millions of Americans once they reach retirement age. Today, I'll walk you through 5 of the biggest retirement tax traps, explain why they matter, and most importantly, show you practical ways to reduce their impact. If you're receiving Social Security, planning to retire soon, or already living on retirement income, this is information you'll want to understand before making your next financial decision. Before we begin, a quick note. This video is for educational purposes only and is based on publicly available 2026 tax rules. Tax laws can change, and everyone's financial situation is different, so always consult a qualified tax professional before making financial or tax decisions. Now let's begin. Tax trap number 1. Social Security may become taxable. One of the biggest surprises in retirement is learning that Social Security benefits aren't always tax-free. Many retirees assume they already paid into the system throughout their working years, so the benefits should come back without additional taxes. Unfortunately, that's not always how the rules work. Depending on your total retirement income, up to 85% of your Social Security benefits may become taxable. The IRS looks at something called combined income, which includes part of your Social Security benefits, retirement account withdrawals, pension income, interest, and other taxable income. As your income increases, a larger portion of your Social Security can become taxable. The important thing to understand isn't just the tax itself. It's that many retirees accidentally trigger it simply by withdrawing too much from traditional retirement accounts without realizing the long-term consequences. Small decisions today can create much larger tax bills tomorrow. That's why understanding how different income sources work together is one of the smartest retirement planning strategies available. Tax trap number 2. Required minimum distributions, RMDs. The second surprise catches retirees when they reach the age where required minimum distributions begin. Traditional IRAs and 401ks allow your investments to grow tax-deferred for decades, but eventually, the IRS requires minimum withdrawals each year. These required minimum distributions, commonly called RMDs, are generally taxable as ordinary income. Here's what many people don't expect. You may be required to withdraw money even if you don't actually need it. Larger retirement balances often mean larger required withdrawals, and larger withdrawals can increase taxable income, which may also affect other parts of your retirement plan. That's why planning ahead, years before RMDs begin, can make a significant difference over the course of retirement. Many retirees don't realize that retirement income can affect more than taxes. It can also impact how much you pay for Medicare. If your taxable income rises above certain IRS and Medicare thresholds, you could pay higher Medicare Part B and Part D premiums through what's known as an income-related adjustment. What surprises many retirees is how this happens. A larger retirement account withdrawal may increase your taxable income. That higher income can later result in increased Medicare premiums. In other words, one financial decision can have multiple effects beyond your tax return. That's why it's important to think about retirement withdrawals as part of an overall income strategy, not just a way to access savings. Tax trap number 4. Every extra dollar may cost more than you expect. Many retirees believe they're in a certain tax bracket, so they assume every additional dollar they withdraw will be taxed at that same rate. In reality, retirement taxes can be more complicated. Additional withdrawals may increase taxable Social Security, raise overall taxable income, and potentially affect Medicare costs. This creates what many financial professionals call a stacking effect. Instead of looking at each withdrawal by itself, it's important to understand how different sources of retirement income interact. Careful planning can often help reduce unnecessary taxes over time. The goal isn't simply paying less tax today. It's creating a strategy that helps keep more of your retirement income over the years ahead. Tax trap number 5. Missing your best tax planning window. Perhaps the biggest opportunity many retirees miss happens before required minimum distributions begin. For many people, the years after retirement, but before mandatory withdrawals start, can provide valuable tax planning opportunities. During this period, some retirees explore strategies such as gradually repositioning retirement assets, reviewing future withdrawal plans, or working with a qualified advisor to better manage future taxable income. Every situation is different, but waiting until mandatory withdrawals begin often means fewer planning options remain. The earlier you understand your retirement income strategy, the more flexibility you may have later. Transition. Now here's the encouraging news. Understanding these 5 retirement tax challenges doesn't mean they're impossible to manage. In many cases, thoughtful planning, regular reviews, and professional guidance can help reduce their long-term impact. The key isn't reacting after taxes increase. The key is planning before they do. Before we wrap up, here's the one message I hope you remember. Retirement isn't just about how much you've saved, it's also about how much you're able to keep. Understanding how Social Security taxes, required minimum distributions, Medicare costs, and retirement income rules work together can help you make more informed financial decisions over time. The earlier you learn these rules, the more planning options you may have. And if you're already retired, it's never too late to review your current strategy with a qualified tax or financial professional. Now I'd love to hear from you. Which of these 5 retirement tax traps surprised you the most? Type 1, 2, 3, 4, or 5 in the comments below. I read every comment, and your feedback helps decide what video I'll create next. If you found this video helpful, please like, subscribe, and turn on notifications so you don't miss future retirement and tax planning updates. And if you know someone who is retired or approaching retirement, share this video with them. A single conversation today could help them avoid costly financial mistakes in the future. Thank you for spending your time with me. Take care, stay informed, and I'll see you in the next video.